Welcome to Lesson 6. Today's lesson is all about planning for your future retirement. Our 3 goals for this lesson are: understand the differences between the retirement plan options available for the self-employed, decide which type of retirement plan is right for you, and determine how much you should contribute each month. Let's get started by looking at the options available to you. There are 4 types of retirement plans to consider, as well as a 401k option. I'll tell you a little bit about each type first, and then you can start thinking about which best fits your needs. First of all, if you weren't sure, IRA stands for Individual Retirement Account. So pretty much anyone with earned income, not just small business owners, can open and contribute to these accounts. Both traditional and Roth IRAs have several things in common, but there are 3 main differences. The first difference is when you pay taxes on your contributions. With a traditional IRA, you pay your taxes when you withdraw funds. With a Roth IRA, you pay your taxes before contributing your funds to the account. The other big difference between the two is that with a traditional IRA, you're required to take a minimum distribution from your account starting at the age of 72. This means that you will take a mandatory taxable withdrawal every year. There aren't required minimum distributions with a Roth IRA, but every other account type we'll discuss today does have minimum distributions. The third big difference is that with a Roth IRA, you can make tax-free and penalty-free withdrawals on your contributions whenever you'd like. This does not apply to your earnings, however. With other IRA types, as well as 401ks, you'll likely pay an extra 10% in taxes if you withdraw your money from your account before the age 59 and a half. Next up, let's look at the SEP IRA. What's different about a SEP IRA is that it's set up by the employer rather than the employee. Any size business can establish a SEP IRA, even if you're the only employee. With a SEP, you can contribute up to 25% of each employee's pay to the account, up to a maximum amount set by the IRS. Doing this for yourself helps you limit the amount you pay for self-employment taxes. For example, if you pay yourself a salary of $75,000 and you contribute 25% of that salary to your SEP, then you're only paying self-employment tax on $56,250. In addition, the contributions you make to the SEP are deductible on your business tax return, so you'll be reducing the company's federal tax bill too. One important item to note is that with a SEP IRA, the employer must contribute the same percentage of compensation for all eligible employees. The last IRA for you to consider is the Simple IRA. This one is for businesses that have less than 100 employees. With the Simple IRA, employees make pre-tax contributions up to a maximum amount set by the IRS. Then the employer can either choose to match the contribution for up to 3% of the employee's wages or set a 2% non-elective contribution for each eligible employee. As a business owner, this means you can make a pre-tax contribution as an employee and also earn the tax deduction for the contribution as the employer. An important item to note with a Simple IRA is that there are heftier early withdrawal penalties than other types of plans. We have one more option to discuss, the solo 401k. This type of plan is just like a traditional 401k, which means that as a small business owner, you can make an employee and employer contribution up to a maximum set by the IRS. The main advantage to having a solo 401k is that you'll also have the flexibility to make post-tax Roth IRA contributions. Another advantage is that the contribution limits are higher than those for the SEP or the Simple IRA plans. So which of these plans is best for you and your small business? You'll definitely want to look at how much you're wanting to contribute and pick the plan that will allow you to contribute as much as you can. This contribution chart is also in our Lesson 6 guide and can help you wrap your mind around the limits. The tax filing deadline for each plan might also be something for you to take into consideration, especially if you're at the beginning of a new year and you want to get something set up and running to count for last year's taxes, or if most of your profits come in at a certain time of the year. Additionally, think about the size of your business and your current and future tax brackets when making this decision. We also need to discuss how to decide on an amount to contribute to your retirement. Most financial advisors will encourage you to contribute 10 to 15% of your pre-tax income to your account. However, if you're just starting your business, this might not be possible for you, and that's totally okay. Just look at your profits each month and contribute as much of those as you think you can. You can start with a lower amount or percentage each month or each pay period, and then increase your contributions as you build your business. What you can't do, however, is ignore your retirement and sell yourself short by not preparing for your future. Make sure you use our Lesson 6 checklist to get yourself on the right track with your retirement planning. In our next lesson, we'll talk about how to read and use an income statement.